Hi, this is Lex, and welcome to the Fintech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Hey, Will, good to have you.
Likewise, you too.
It's great to get back together and talk fintech again after the long winter break. It's a new world, but it's the same world. And so today we'll talk about three things that are the same. They're all from the past, but they're sort of having this interesting renaissance. We'll chat about SoFi and the SPAC around that, around Bakkt, Bakkt, and the SPAC around that. And then, of course, our favorite embedded finance player, Plaid, and the Visa deal. So that's our agenda today.
Is it pronounced Bakkt or Bakkt? Bakkt sounds like the European pronunciation.
Oh, well, being in London, I have to give it the German treatment, you know.
Okay, got it.
So what's going on? What's going on with SoFi?
All right, so as part of this this now fully fledged SPAC boom, SoFi is acquired effectively. They're the target. They're of a combination. So a combination with a SPAC run by this guy Chamath, whose last name I can't pronounce, who has just an amazing legacy in, I think, first Facebook and then venture capital, and then most recently SPACs. And for a full deep dive on SPACs, especially SPACs around fintech and how they work and some of the dynamics and incentives and why some investors think they're a great thing, there's a Rebank episode that we did late last year with Ryan Gilbert, who's the CEO of Olympus Acquisition Company or corporation or something, NASDAQ listed SPAC. I think they raised something like I'm gonna forget this, but something like $750 million. So in the case of the SoFi combination, this SPAC or maybe combination of SPACs or vehicles had raised something like $800 million in cash, and they're also now, as part of this deal, raising like a 1.2 billion ballpark private, basically private placement, a PIPE, to help fund this acquisition. And long story short, SoFi being acquired by a publicly listed vehicle is assuming this all closes, will be publicly traded. The SoFi ownership kind of rolls up into these listed SPAC shares. The SPAC shareholders, assuming they approve the acquisition and stay in it, become shareholders of SoFi. And it values SoFi at something like $8.65 billion, which is something like, I don't know, 2 billion, 3 billion more than its last private funding. And it's something like, half of what Chime is valued at now, and it's lower than, I don't know, Robinhood and some others. And basically the SoFi concept is originally student loan refinancing. So people pay 8% to borrow from the U.S. federal government for education loans. Everyone does. Doesn't matter. They don't even look at your credit score, I don't think. And what SoFi said is people that graduated from Harvard are probably lower credit risk than the 8% would reflect. So we can actually refinance their student loans at 4% or 3% or whatever it is. And this has been a great business. And basically from there, they branched out into a traditional, diversified banking offering. So everything from personal lending to quote unquote checking accounts. I think they're actually run on a brokerage stack, debit cards, investments, and they have this great growth story going forward that they're telling to everyone who participates in the existing SPAC and might also become a shareholder in the future.
Yeah. So if I could hop into caricature it even a little bit more, right? Like, as you're saying, 10 years ago, 12 years ago, whenever it was, SoFi is starting to do this arbitrage. They're arbitraging the government's decision to non-discriminate for student loans. And it's a 400 basis point arbitrage, and they're getting all the sort of wealthier, better credit students from business schools and law schools to come to them. And if you're running a lending business, all you're doing really is printing money now, because you're taking fees up front, and you've got credit risk way, way, way in the back. So on a revenue basis, you look pretty fantastic. And so because you look fantastic, you might pick up 500 million or $1 billion from your friends at SoftBank and all of the other fintech VCs, which are trying to build gigantic consumer brands, and are doing it on consumer growth and revenue growth, and not really are super worried about credit risk. Now, you fast forward 10 years, and the world is in many ways on fire. Everybody's bankrupt. Money is being printed every which way. And it so happens that your largest investor, SoftBank, itself is losing $12 billion, printing $10 billion options contracts on tech companies and all sorts of shenanigans. And you start getting calls. You start getting calls from a variety of billionaires, from people that are managing hedge funds and creating these SPAC structures, to the Facebook billionaires like Chamath, who are printing SPAC structures, to fintech billionaires or mere decamillionaires like the Bancorp's Betsy Cohen. And so you start getting these calls saying, wow, you have some nice economics, let's go public. And so I think this is the first sort of fancy one, right? The first fancy fintech that is going this route. Is that fair to say?
Yeah. I mean, I think from what I've seen, yes. Maybe where some of the other SPAC combinations in fintech has been more like kind of payments and infrastructure, and the stuff that makes a lot of money that is less kind of noteworthy household name consumer brand. SoFi definitely is. I forget which stadium in California is. I think in California is called SoFi Stadium. I don't know, maybe San Francisco or something. But clearly a consumer brand, and I think that is actually useful in many ways. We talk about markets being super efficient, and it's all about discounting forward cash flows and whatever. But actually, I think there's a lot of human psychology in it too, and having a household name brand can be valuable. A few thoughts that I wanted to share as we dig through this. So, firstly, one of the points that Ryan Gilbert made in the podcast we did, probably 2 months ago now, around why a SPAC and why it was, in his view, better than an IPO, but at the very least, what some of the differences were between SPACs and IPOs. One of the things that he called out was the fact that, especially around tech businesses and taking tech businesses public, or rather like kind of VC-backed tech startups, right? The type of business that burns cash for years and then eventually, if all goes well, makes a lot of money in the future. What he said was, for an IPO, you can't provide like forward-looking statements. You can't really talk about the future. And with a SPAC combination, you can, because actually the SPAC is already publicly listed, and really all they're doing is just buying a company. And so it's kind of a shell company, and therefore the target ends up effectively publicly listed, but without the IPO process and all the regulations that come with it. So basically, they could make forward-looking statements as they're talking about the SoFi acquisition and how good SoFi is going to be going forward. And if you scroll through the deck, right, the investor presentation that they put together, I guess to encourage the SPAC shareholders to support the deal. It reads like, what's the right word? Quite optimistic, for lack of a more loaded term. I mean, it's literally, you're looking at a company that has burned cash, that has lost significant amounts of money for years, like basically forever, and magically starting in 2021, everything's profitable, and by 2025 they make $1 billion in profit. And there's some information about, I don't know, how they expect their like customer base to evolve, how they expect the products that they currently offer to grow, and where they expect to add new products, and how basically the economics of SoFi in the future, at least in terms of the direct to consumer business, work if they can deliver, I think, what they call cross buys, but what Wells Fargo and their phantom account targets call cross sell. Like the more you can cross sell,
Be nice.
the more you can cross sell your existing customers, the better your economics. Okay, that appears to be the concept. SoFi definitely offers a broad range of products, but I think it will be interesting to see whether they can cross sell their customers to the extent that they hope they can. And also, I guess, the extent to which the product offering that SoFi has and the economics around individual products, how well those actually pair kind of with each other around the existing customer base that SoFi has. And just to round this point out, Lex, and I'll pass it over to you. Ann Bowden of Starling told us something interesting in a conversation we'd had with her, again, probably a month or two ago, which was basically that if your customers are middle income, skewing affluent, i.e. they're cash rich, and you're offering them checking accounts and debit cards and investments type products, they're probably not also in desperate need of personal loans. And at least in the Starling example, they run the liability side of their balance sheet, i.e. the deposits, with that more affluent user base, and then they're basically looking at other ways of deploying that capital, the asset side of their balance sheet, not directly to their existing customers. So if you look at the SoFi presentation, it basically talks about cross-selling checking account holders with personal loans and with, I don't know, credit cards and with student loan refinancing. I think there's some products in there like home mortgages and potentially student loan refinancing that do make sense for cash rich Henrys, like the type of customers that SoFi has and I think continues to target. But there are other products in there which I'm just not sure are most easily distributed to people that already have cash flow, that are like white collar professionals that graduated from these Ivy League or top tier schools that we were talking about at the very beginning, and that came into SoFi via the student debt refinancing offering. Now, you know what? I'll pause there, and then we can bring it all together around Galileo after I give you a chance to share a little bit.
So, one part of me really wants to cheerlead for SoFi. There are only so many quote unquote good large fintechs, and SoFi has built a fantastic brand, and it's done lots of people a huge service through really useful products. Like I was a SoFi customer when I was at Columbia doing the JD MBA, and they saved me a whole bunch of money, and it was obvious that they were saving me money the moment I signed up for their product. And so I'm a huge fan. And I think the sort of the profitability point, lots of people will point to Amazon and hand wave various tech company arguments that I think at this point we're sort of beyond, right? So there are a couple of things for me that stand out. One of which is, we're actually seeing some data about SoFi. So end of 2018, they had 650,000 users, members, customers, whatever. So 650,000, which is not, that's not worth $1 billion in venture funding. And today they are at 1.7 million, which is getting closer. So 1.7 million, so about 2 million people. Is that should that be a $2 billion valuation, which is kind of $1,000 per person, or should it be an $8 billion valuation, which is $4,000 per person? I think that's one of the gaps relative to market that we see based on the other players like Starling and Monzo and Revolut and Chime, where we can do the math. Arguably,
it's tough to know, right? Because if they're if they're users of their like free financial, I don't know, like budgeting tools, then it's probably not worth very much. And if they're all student loan refi customers, then it's probably worth a lot. It's tough to know.
Yeah, and I think it's that, and I think it's probably the borrowers, which means this is a very transactional business. This is a business where every year you're starting to generate new loans from scratch, which gets me to to this other point, which is we've been talking about bundling and rebundling the product set, and kind of how SoFi is aggregating everything, and Revolut's aggregating everything, and Square's Cash App is aggregating anything. And SoFi, they have a robo advisor. They've got wealth management. They've got mortgages. I think they got some insurance thing. They've copied Robinhood. They've got, I think, crypto access. And so for me, what was kind of like wild was seeing the revenue chart. So they generate in 2020 $620 million in revenue. Now, that is fantastic for a fintech startup. Granted, again, multiple billion in funding, but still pretty good. Now, if you look at that 620 million of revenue, 80% of it is lending. 80% of it is underwriting, right? So 514 million, they say, is from underwriting. And now that can be mortgages and student loans and et cetera, et cetera. But that is transactional borrowing, where you have a very certain relationship with your client. Now, another 100 million is from the quote unquote tech platform, which we'll put a pin on about Galileo and sort of the gem that is. And then 11 million is from financial services outside of that. Now, I don't know how this all breaks down, but it was very surprising for me to see that sort of like the bundling thesis is generating 10 million of other financial services revenue. The Robinhood competition stuff is generating 10 million bucks relative to 500 million of kind of core lending. So end of the day, what you're buying in this SPAC is a consumer lending business with a couple of bells and whistles attached. And that's somewhat different from what I expected it to be honest with you.
So I can't remember the exact number. I think maybe it was something like 50 million. But they talked in the press release about earmarking 50 million specifically to restructure SoFi's balance sheet to make it more conducive to an OCC banking charter. So, SoFi had already applied, I think, for a banking license. It kind of been back and forth, but I think most recently, within the past year or so, they had reapplied or made it clear that they were going to, and so it does appear that there's a continued push in that direction. And to your point about, okay, your lending business, low cost funding is important if you're a lending business. If you have a banking license now, NIM is potentially, net interest margin, potentially one of if not your biggest revenue stream. And if you look at SoFi's product set and who they appear to be looking to appeal to, it's more or less akin to like a Chase or something, right? They have lending, they have personal accounts, they have investments. Looks like they're going to have credit cards in the future, and they're trying to appeal to this middle income, skewing affluent user base. Chase is valued at 1.7 more or less times book. Now, we don't have visibility into SoFi's balance sheet, but it just gets back to this question that I think those of us in digital banking have been asking ourselves for years now, which is, does the kind of bridging that gap between, crossing the chasm between tech valuations and bank valuations, and how do you look to support a tech valuation because you're offering great technology and you're efficient and you're, I don't know, riding the wave, versus the fact that a lot of your peers, especially if you're SoFi and you get a banking license and you continue to offer this bundled financial services offering, you really end up looking a lot like Chase. So question mark around valuation and how that trends over time. When you're ready, we can tie it together around Galileo.
Yeah, absolutely. And so I think they want to be this diversified player. They want to have 30% of their revenue come from investing and asset management and banking deposits. And I think if that happened, if that were the case, generally speaking, people will be better off. It will be a nice service that works and that people like, but it does hit that valuation point that you describe. The final bit in their business that's revealing is this 100 million of revenue from the tech platform, which is surprisingly high for me. I don't know if there's some categorization stuff going on, but the tech platform is Galileo, which is an embedded finance sort of API play that supports a number of American neobanking platforms like Chime and Moneyline and SoFi itself, in providing a pathway to cards and banking services. And this was, not to get ahead too far, but this was kind of 3 deals were announced at the same time. Plaid and Visa for $5 billion, with the idea that Plaid's revenue was around 150 million then. Then Finicity and MasterCard as a competitive response. Now Finicity has closed the $1 billion acquisition with MasterCard. And then, of course, the Galileo SoFi acquisition, which was also $1 billion in headline and about 90 million in cash, the rest in SoFi equity. So there was this moment in time where this made a lot of sense, and it's quite interesting to see it making such a chunky amount of the value proposition in this sort of like SPAC IPO process. What do you think about Galileo? Is this kind of worth its salt?
Yeah. Yes. All right. So I think that the Galileo piece here is nothing short of the future of SoFi. So I definitely don't want to underplay the relevance of having a banking license and literally printing money, right? Not only in literal terms, i.e. the way that loans are made and how they end up as deposits in bank accounts, but also the fact that with net interest margin, with the fractional reserve model, you make tons and tons of money as a bank. So even like valuation aside and price to book versus price to earnings or whatever it is, you print money as a bank. So great, and time tested business model. So I'm SoFi is at no risk of ever collapsing or running out of money in the future if they go the banking route. But I think that the even more interesting space is effectively embedded lending, for lack of a better word. And you can argue about what's embedded lending versus what's providing wholesale facilities and how everything works in traditional and forward-looking terms. But in terms of what Galileo does, you talked about how they support a large number, the vast majority, I think, from a customer standpoint, i.e. how many consumers are using these banks, the vast majority in the US and increasingly in Latin America where they launched last year. So we went deep on Galileo, their business model, and even the SoFi acquisition of Galileo last year with Clay Wilkes on a Rebank episode. Very, very relevant. I would highly recommend everyone check that out. Clay's an amazing guy. Galileo's an amazing business. And we even talked about it then, right? Like in that conversation with Clay, it seemed then, and it seems now, like the opportunity is for SoFi to deploy its balance sheet via Galileo to the Galileo customer network. So you talked about Chime. Right now, Varo's gonna, I think they're gonna move onto some of their own technology. I don't know about their relationship going forward with Galileo, and a number of others, and also now increasingly large number in Latin America. So you're talking about tens, if not soon to be hundreds of millions of consumer customers of these neobanks that all, in one form or another, run on Galileo's infrastructure. And the ability for SoFi to effectively lend money via Galileo to accelerate the product offerings around credit for all these neobanks and end up with credit cards, with personal loans, with potentially other types of lending, even the student loan refi, even mortgages potentially, in the wallets and in the pockets of the customers of every single one of these neobanks. Like the distribution network is massive. If you pair that with a low cost of funding of SoFi as a deposit taker post banking license, I think that's really the opportunity to achieve unprecedented scale in the banking space because they own the infrastructure, and the industry is clearly going in a direction where offerings like Galileo's, this banking as a service / embedded everything, from payments to lending to other products, like is very likely to be the future. And to me, this is massive fertile ground for SoFi going forward.
Yeah. And this is why I'm so excited about my favorite public market company, not investment advice, the Bancorp, right? Because the Bancorp's like, this stuff is also interconnected. So the Bancorp is doing the actual cards and the issuance for a lot of the Galileo stuff. Notably, the Bancorp's founder, Betsy Cohen, is one of the folks who's been printing these Fintech SPACs, now on number 5. So it's the whole thing is the industry is very interconnected. So I want to race. I'm going to reorder and say let's connect into Plaid and Visa, just because the Galileo discussion is so close to the heart. So the piece of news is that Visa was buying Plaid for $5.3 billion as part of its thesis around being the network of networks. One of the networks being API connection of data into all of the fintech companies. And so Visa would like to do that via Plaid being the leader in data aggregation and sort of payments like API connectivity. And then for fairly mysterious reasons to me, the antitrust authorities decided to try and block this deal and put together a lawsuit. I mean, in terms of things that matter for antitrust in a world where Apple is worth $2 trillion and Google and Facebook are there as well, stopping a Plaid acquisition seems really not important, but here we are. And so today or yesterday, it's been publicly called off. So Plaid will not be acquired by Visa for lots of reasons. One of the reasons that I suspect is the Google Pay application. So Google's core financial application, which recently came out fully stacked with FinTech features, is powered by Plaid for data aggregation. So that's closed, that's released, that's in the wild, that's a Plaid customer, Google's a Plaid customer. So that's a lot of leverage for Plaid. So I guess my short take on this would be, from a financial perspective, I think that the cancellation of the deal is probably a loss for Plaid. But from a strategic perspective, it is for sure a loss for Visa. What do you think?
So that's an interesting one. I mean, the market moved so fast since the time that this deal was originally announced. Like, it wouldn't surprise me at all if Plaid's valuation, is now, higher than even what Visa would have been offering. Like just because of how fast everything has moved. So potentially there's actually some value created for Plaid as a result of this. Look, Plaid has a strong business because they have lots and lots of customers, and they've done the hard work of connecting all the banks. I think they're in the process, it feels to me, and I sure hope they are, of almost like taking the next step, which is to get closer to banks. And instead of, like version 1 was screen scraping, version 2 is, some banks start offering APIs. Version 3 is like Plaid needs to like show up, especially at the banks that it has antagonistic relationships with. I think Capital One is one of them. I think PNC is one of them. And I think there are a handful of others. Like should just show up and say like, we're your partners, and we're going to do the work, and we're going to get you connected, and here's the value that we're going to create for you. And really just like push this whole space forward and actually do an amazing service. They've already done a great service for the U.S. Financial services market and customers, at the end of the day. But I think there's so much more that they can do. Now, I have to admit that because we're talking about data and different ways of monetizing data, and it gets pretty nebulous in my mind pretty fast. Like I think they're really smart people that for whom it's intuitive, like exactly what the 10th step is for Plaid and where the monetization comes from. post just the simple API call paper call model that they currently have. And in fact, those people who fully understand the economics of the data aggregation model and all its nuances and where it could go, it'd be fascinating to get some insight. But that's, I guess, always a bit of a question mark in my mind. I'm sure there are lots of interesting places you could go. You probably have a clearer sense than me. I'm just not sure what they all are.
Yeah, it's another one of these names that I want to cheerlead because we're on their team. Like I want them to win, But if it was $100 million at a $5 billion valuation, let's say they kill it, and now they're running at $1 billion in revenue on API calls, on data aggregation. Is it really look at Thomson Reuters, look at Finastra, look at any of these companies that are sort of in the Bloomberg-ish intermediation of data business. That is not a 50x revenue. So I think if they were printing $1 billion in revenue and were at $400 million in profit, which I can see them getting there in the next couple of years, that to me is still not a $15 billion business. I mean, so I do wonder about that, about how this will end up playing out. But I could see them, if I'm, for example, Microsoft or IBM, if I felt loose with my leverage, I would definitely consider, or if I were Goldman Sachs too, I would definitely, consider spending $5 to $10 billion on Plaid to have the number one position in the market.
Interesting. Oh, but I did want to say one more thing there, which is that Visa, this I think is most damaging for, I won't say damaging, but I think the Plaid acquisition by Visa was a huge opportunity for Visa, huge opportunity, and this this is something of a setback as a result. What does Visa do now? More of the same, so to speak, more innovation along the lines that they're already innovating, like the kind of payment by card rails. I think they call it Visa Direct and other things like that. And of course, just a cash cow of a business. And I'm sure there, continue to be massive growth opportunities around online payments and maybe in emerging markets or whatever it is. But this acquisition to me felt like an opportunity for Visa to really make something of a quantum leap in terms of being the main payment connectivity provider of the world.
Yeah.
And so a bit of a blow for them for sure.
Poor Visa, just left over a $500 billion market cap. It's so hard. Look, we're always run a little bit long in the tooth, and here we are. So let's close this out with Bakkt, whatever German techno band name you'd like. So this one is really quite interesting, and it connects to the point you made about you can make forward-looking statements, And so the background on this company is that it's owned by ICE, the Intercontinental Exchange, which owns the New York Stock Exchange and a whole bunch of other global capital markets exchanges. And exchanges generally are they have no idea what consumers want. Exchanges know what large capital markets firms want. They know what hedge funds and market makers and other manufacturers of financial product want. But in this case, we had sort of a couple of weird years where crypto assets like Bitcoin and Ethereum and Ether on Ethereum, but also digital assets like blockchain anchored private equity or real estate and so on, were driven by retail adoption and not by institutional adoption. And so one of the things that this exchange group did was try to launch a crypto exchange infrastructure. Now, Coinbase, which is going to IPO shortly, probably for somewhere between 15 to 30 billion in market cap, or Binance, which is just as valuable and prints multiple billion in revenue, those are crypto exchanges and people use those. Bakkt is a business plan with regulated infrastructure. And so it largely relies on kind of regulated adoption or institutional adoption and to be the venue for institutional trading of crypto assets. There's lots of players that do this. Gemini, with a Winklevoss, and a variety of other players, Cumberland, and so on. There's BitGo as the custodian. And so when you look through the materials of the company, there's a lot of emphasis on what they've built and the institutional relationship to the exchange. And then there is just like this unbelievable, truly unbelievable chart of user growth. And like the user growth starts in 2021 and it's 0 in 2020. And then they curve it up. And on this, to 30 million people. And the other charts on the page are Chime and Robinhood. So this representation that 30 million people are going to show up to use the app, to me, is pretty wild. Just to close it out, on the positive side, they've got 400,000 people who've signed up to get the app when it's ready. They've got a partnership with Starbucks, given, again, this is a large company that's doing it. And then the SPAC that's trying to take it out is valuing the whole thing at around, I think, a little bit over $2 billion. So I find this really interesting because it's sort of this pre-product market fit concept phase, internal technology build thing, which is going public before winning the market. And I wonder whether it even, does it even hit your radar, or is it just an operation in crypto land?
I'm going to speak as probably like your average consumer of crypto, news and information. And, I kind of maybe watch it out of the corner of my eye, mostly when Bitcoin hits 40,000. And I'm like, what just happened? Oh my God, this is so interesting. Oh my God, I should have invested in this such a long time ago. And then, and then you see stuff like Bakkt. And on the one hand, you're like, simplistically, oh wow, okay, this must be the future because Bitcoin's at 40,000, which I assume is how most, even smart people and investors and people in finance think about the world, or at least think about these things in crypto. But the biggest question mark in my mind, like when I read about Bakkt, is what is it? Like it says it's a consumer app where you can manage basically all of your digital assets. And I think their definition of digital assets is like Bitcoin, cryptocurrency, Starbucks, credits, and Target gift cards, and Delta Sky Miles, or whatever it is, like all these things, and you can just manage them all in this app. And I don't even know what that means. Like the implication as I read it is like somehow you can convert them into fiat and/or they become fungible, and that sounds really powerful, but it's a pure hunch, pure assumption based on reading that material. Otherwise, I'm not quite sure what the app does. I just don't understand it.
Correlation, not causation. I think in 2017, when I was looking at this stuff, more closely from an equity research perspective, we saw a whole bunch of companies, like 30 different companies, change their name to have the word blockchain in it, and then they all got like a 20 to 30% price bump because people do trade on just a really shallow understanding of what the company does. I think what to me is weird here is I do believe they will have one of the strongest regulated exchange infrastructures for cryptocurrencies as well as tokenized assets, whether it's the Sky Miles or something else. But I think they're wildly underestimating how incredibly difficult it is and expensive it is to actually build a 30 million user consumer footprint. And on that, it's a wrap. Thanks so much for joining, Will.
Thanks to you. Fascinating as always.